By the time a startup announces its funding round, the story feels finished. The press releases are written. The headlines are optimistic. The founders smile for photos. But internally, something dangerous has already started. Funding does not remove risk. It reshapes it. Before funding, the biggest fear is survival. After funding, the fear becomes expectation. Suddenly, the company isn't trying to prove an idea. It's trying to justify a number, a valuation, a growth promise, a timeline that wasn't chosen by the market, but by capital. This is the moment when many startups quietly stop asking, "Does this work?" and start asking, "How fast can this look like it works?" That shift is subtle. It's rarely discussed. And it's where long-term failure is often locked in. Because once funding enters a system, decisions are no longer just strategic. They become defensive. Investors don't usually demand failure. They demand speed. Speed to scale. Speed to dominate. Speed to justify the bet. And speed changes behavior. Hiring accelerates before systems exist. Marketing spends grow before retention is proven. Revenue projections replace customer reality. At this stage, founders often believe they're being bold, but in reality, they're reacting. Reacting to board meetings, reacting to benchmarks, reacting to comparisons with companies that had completely different conditions. What gets lost is patience. And patience is what early companies need most. This pressure doesn't feel aggressive. It feels reasonable until it compounds. And once it compounds, the startup isn't steering anymore. It's being pulled. At a certain point, growth stops being a signal. It becomes a product. Users are acquired not because they stay, but because they look good in metrics. Revenue is celebrated even if it's temporary. Churn is ignored because it's harder to explain. Internally, teams know something is off. But externally, the story must remain clean. Because once growth slows, questions begin. And questions make the next round harder. So companies push harder. They discount. They overspend. They chase vanity instead of durability. And slowly, the business becomes fragile, even as it appears stronger than ever. This is the most dangerous phase. Because failure doesn't look like failure yet. Burn rate is rarely discussed publicly. But inside the company, it's always present. Every hire, every campaign, every expansion decision. It's a clock. And once funding arrives, that clock gets louder. The runway feels long until it suddenly isn't. What founders often underestimate is how fast complexity increases costs. More people means more coordination. More tools mean more overhead. More markets mean more mistakes. And burn rate doesn't slow when growth slows. It accelerates. This is where startups start making survival decisions disguised as strategy. Cutting quietly, delaying payments, renegotiating expectations. From the outside, nothing looks wrong. From the inside, the margin for error is disappearing. Founders rarely talk about this part because it's personal. After funding, they're no longer just builders. They become managers of pressure. Pressure from investors. Pressure from employees. Pressure from the story they sold. Admitting uncertainty now feels like weakness. So they push confidence, even when clarity is gone. This is where decision-making changes. Not because founders become reckless, but because they're trapped between truth and expectation. And the longer that gap exists, the harder it becomes to correct course. By the time reality forces honesty, options are limited. Ironically, funding can make startups less flexible. Early on, pivoting is natural. After funding, it feels expensive. A pivot means admitting the original thesis was wrong. And that's not easy when millions are attached to it. So instead of real pivots, companies make adjustments, small changes, new features, rebranded messaging. But the core problem remains. And because money is still flowing, there's no immediate urgency to fix it until there is. And when that moment comes, it's usually too late to pivot cleanly. Markets are indifferent. They don't care about funding rounds. They don't care about press coverage. They don't care about ambition. They care about value. When startups confuse valuation with validation, they lose alignment with reality. Customers don't behave according to pitch decks. They behave according to utility. And when the two diverge, revenue becomes unstable. This is when companies start chasing explanations instead of solutions, blaming timing, blaming users, blaming competition. But the truth is simpler and harder. The market is responding honestly. There's a moment many founders recognize instantly. Emails take longer to get replies. Meetings become less frequent. Language becomes cautious. This isn't panic. It's evaluation. Investors rarely pull support suddenly. They observe. They wait for signals. They assess optionality. And during this period, startups are often still spending aggressively, assuming confidence that no longer exists. This is when the gap between perception and reality becomes dangerous, because the company still believes help is coming, and help often isn't. Most startup failures aren't explosive. They're quiet, a missed payroll, a delayed round, a strategic pause that never ends. Employees leave gradually, products stagnate, momentum fades, and eventually, the company stops being discussed, not because it was stupid, not because it lacked effort, but because early decisions made under pressure created a structure that couldn't survive reality. Funding didn't cause a failure. It revealed it. There's one question that determines survival, and most founders never ask at the right time. Not, how do we grow faster? But, what would happen if funding stopped tomorrow? Very few startups are built to answer that honestly, because answering it requires confronting uncomfortable truths about demand, about discipline, about whether the business stands on its own.